Hello and welcome to the Genuine Learning Blog. My name is Melissa Galasso, and today we're going to talk about an interesting topic coming out of the AICPA's expert panel for healthcare, which is how do you account for vaccines related to COVID-19? So there's some interesting nuances to how these vaccines were delivered and what the appropriate accounting would be. So let's take a look at what they discussed. So the AICPA issued a TQA, or technical Q&A, in 6400.71, and the topic is accounting by a recipient entity for vaccines or other pharmaceuticals, medical supplies, or equipment received for distribution to, here's that key term, specified payments. So this was just issued in February 2022, and it's really trying to address a very interesting issue related to the vaccine rollout for COVID-19, but also on a much larger scale. You'll notice that they don't limit it to vaccines. They really look at it for this concept of a specified party. And the background on this is often pharmaceutical companies or other providers distribute specifically for certain types of patients. So whether it's a right to try program or a clinical trial or a prescription assistance program, right? They are distributing these pharmaceuticals free of charge. And they are typically required to obviously be dispensed by a healthcare entity that is licensed to do so. So you can't just, give them to anybody, but they go to a particular group of services and they can only be applied to the specified patients or patients free of charge. Right. And so when we think about some of the application here, right, we had different levels and different groups who were eligible for the vaccine at different times. And so typically the arrangement is between the healthcare entity and the pharmaceutical company, and it doesn't allow them to dispense outside of those specified patients and requires that if they aren't dispensed to those patients, they have to be either returned or more likely in the case of COVID-19, they had to be destroyed because they had a very short shelf life. This does not apply that when they are looking at this TQA, they did not address anything related to conditions. They were just looking at this sort of scenario. And so when we think about the way this works, there's typically three distinct parties. There is the resource provider, who is typically going to be a pharmaceutical company, but it could also be a local government or a government agency, right? A lot of these were funded with federal funding. So it's very broad. Pharmaceutical companies tend to come to mind, but it could be federal, state, local governments, federal agencies, et cetera. And then it goes to the healthcare entity who's going to receive custody of these items. And when we're looking at this TQA, it is not dealing with governmental hospitals. It is dealing with healthcare entities that are either for-profit healthcare business entities or non-governmental, not-for-profit healthcare, right? So you're going to be in the FASB world in terms of the application here. So you're either a for-profit hospital or you're a not-for-profit hospital. This does not address governmental accounting here. And then ultimately, who is getting this vaccine? Obviously, it is the specified patient. And that could be either an identified patient, like an individual, but it also could be a category of patients. It could be based on risk categories, geographic location, or even age as we go through this. And so when we look at this, obviously the resource provider provides these vaccines for the benefit of the specified parties. And so the question that was raised is, should a healthcare entity that receives items, again, free of charge, to dispense to specified patients recognize the fair value of the items within their financial statements? So that was the question that was raised. And the answer is very much, it depends. There's actually a lot of different considerations that we have to think about when we're doing the accounting for these vaccines. And so we're going to kind of walk through all the different sort of steps. And so they are not written this way in the TQA. I'll be honest. I thought the TQA was very wordy and had a lot going on. It's super helpful, but hard to kind of follow the flow. Because there are just so many different considerations. So we're going to use more of a flowchart type of thought process with some steps. So step one is evaluate if this is an exchange or non-exchange transaction, right? So that's sort of the first conversation. Are we an exchange transaction? If we are, we're going to go to topic 606 and we're going to follow the rules there, the disclosures there, and we're going to just be in our normal place. But if we conclude we're a non-exchange transaction, then there are some more considerations that we have to make. So obviously step one, look at the indicators of whether it is an exchange or non-exchange transaction. When they updated 958-605, ASU 2018-08 gave some really good indicators to help us understand, is this an exchange or is this really a non-exchange transaction? Assuming that we have a non-exchange transaction, step 2 is to figure out, well, what is our healthcare entity type? Are we a not-for-profit entity? In that scenario, we are going to apply 958-605. Right, so pretty consistent with other TQAs who've come out about various funding for related to COVID-19. If we are receiving this as a non-exchange transactions, we have a section in the codification 958-605, which is revenue recognition for not-for-profit entities, grants, and contracts. We would just apply that information, right? So, as we go through this, if you're a not-for-profit organization, right, this should make this pretty easy. Where it gets a little bit more complicated is for-profit entities. So there's no specific guidance in GAAP about for-profit entities and how we handle these, this relationship, right? So when we look at this, we've had a lot of different TQAs come back over the years and say there's a couple of different ways you can do this. And one of them is to apply 958-605 by analogy, which is what this TQA is going to cover. Again, there are other alternatives in there, but this TQA is going to assume that we've elected to apply 958-605 by analogy for the application of these items. There are other options that are out there, but they're not within the scope of this TQA. So once we've determined what type of entity we are, the next thing, once we're in 958-605, we are going to have to determine if we're acting as an agent or intermediary in an agency transaction, or are we really acting as a principal? And so remember, when we have an agency transaction, we have a resource provider gives to a recipient organization and indicates that that organization must provide those items to a beneficiary who is not financially interrelated with the recipient organization, and to which there is no variance power. So in a traditional transaction, right? So we have from the resource provider to the beneficiary, from the beneficiary to the to the resource provider to the beneficiary, right? We have a sort of a middleman consideration here. Now, the rule of thumb here is if we are acting as an agent or an intermediary, we do not recognize revenue, right? So we have a policy there that if we are just literally transferring things between, we do not recognize revenue as that recipient organization. Now, the exception to those rules are if we have variance power or we're financially interrelated. And remember, variance power is the unilateral power to redirect the use of the asset to another beneficiary. And the donor explicitly must grant variance power if the entity's unilateral power to redirect the use of the asset is explicitly referred to in the instrument transferring the assets. So what does this mean? It means that the recipient organization, they receive the vaccine from the resource provider. If they can override the donor's instructions without approval, right? They can pick another beneficiary or another interested party, then they have variance power. If they can't change the beneficiary, then they don't have variance power and they're acting as an agent. But if they are able to change who the beneficiary is, then they have variance power. So very important distinction that has to be made here. The other exception to the rule is if they're financially interrelated. The beneficiary and the organization that's receiving are so closely aligned that the net assets of the other organization is tied to the recipient organization, or the other organization solely exists for their benefit, right? So those are the two exceptions to the rule. So now that we've made the determination, we actually have to do the accounting. And so when we get to the accounting for these, if we're acting as a principal, right? So where we have either variance power or we're financially interrelated, right? In those scenarios, we're not acting as an agent or an intermediary. So we are going to recognize revenue. So if it's a not-for-profit organization, it would be revenue. If it's a for-profit, it would be some other type of income, right? For those contributed non-financial assets that are going to be distributed. So they recognize revenue, and then they would have typically an expense when they provide it to the other organization. If you're acting as an agent where you're just facilitating it and you don't have the ability to change who receives it and you're not financially interrelated with the other organization, then you are permitted but not required to recognize those as an asset and liability. So typically what would happen is, say it was just cash, right? So the organization would receive cash, we would debit cash, and then we would credit a liability, and that liability was to the beneficiary. And then when we gave it to the beneficiary, we would reduce the cash, obviously, and reduce the liability. So we would be able to just clear them out. So it's a balance sheet only transaction. When it's a non-financial asset like a vaccine in this scenario, then you're permitted but not required to do that. So you should apply whatever your accounting policy is. If you don't currently have a policy, remember when you make your determination, you are basically electing a policy. So that would be your policy for other transactions in the future. So that's one of the things that was really important about COVID is once you pick a methodology, that is your accounting policy, and you can't just kind of change your policy for each different activity. So assuming that you're either going to recognize revenue or other income as part of this, or you're trying to value the asset, what is the fair value, right? So now we get into fair value considerations, and now we have to think about the lack of marketability, right? You can't sell this on the open market. There's very little transfer value, so you have to determine what the appropriate fair value is of these non-financial assets. So some very important considerations here for how you even value the transaction once we determine the appropriate accounting. And then last but not least, when we get into the accounting, obviously not just the financial reporting side of the house in terms of the numbers, but also the disclosures. So if you're a not-for-profit entity, right, this is a contributed non-financial asset. So ASU 2020-07, which is effective this year, would kick in, and we would have new disclosure requirements and new presentation requirements for those items. If you're a for-profit entity, you should think about analogizing ASU 2020-07 if you're following contributed non-financial assets as your accounting mechanism. But you also have to think about ASU 2021-10, which is new disclosures for for-profit entities, for business entities, about the government assistance that they're receiving when you are analogizing some other type of, either nonprofit GAAP or IFRS. They now have certain disclosures that you have to provide. So this is, as you can see, a pretty tricky issue. There's a lot of ins and outs and considerations that have to be made when you have a healthcare organization who has to account for these. And so the expert panel thought a lot about this and wanted to give really good guidance. So we should thank them for their hard work in this area. And the TQA is available for reading. Again, it's a nice lengthy walkthrough of all those considerations. All right, guys, I hope this helped you for those of you who are trying to deal with accounting for vaccines. But if you are potentially having to just think about how this accounting plays out for other types of items, as I said, it's not limited to vaccines. The goal of it obviously was focused on COVID-19. But again, this will become accounting policy for entities who go through the election this time around. It was wonderful having you today on the Genuine Learning blog, and I hope to see you on a future blog. Have a great day, guys. Bye-bye.